All right, Walter Wofford back, Jackson, Mississippi. Seller financing is near and dear to my heart. As a matter of fact, my first 17 houses I bought starting in 1981 were all purchased with seller financing. And so I got good at getting owners to say yes and being able to share the benefits of seller financing, and there are many. So in this video, I'm going to show you what I do to get sellers to say yes, nodding their head in the right direction for accepting a seller finance offer. You'll like the clauses, and I bet you'll make them yours too. Now, here's one thing I want you to know. The only thing that counts, the only predictable factor in your success in seller financing is how many written offers you make. Not how many appointments you make, how many written offers. So with that encouragement, let's dig in.
Today on the deep dive, we're really going to cut through the noise. We're unlocking the powerful world of seller financing in real estate. We've pulled together some incredibly practical, really in-depth material, from a whole stack of sources. And our mission, really, for this deep dive is simple. Extract every critical insight, every actionable nugget, so you can be not just well-informed, but strategically empowered in this, let's face it, complex area.
That's exactly right. And, while the material we looked at, it does assume maybe a little baseline understanding, we're absolutely here to break down the essential concepts for you. We're focusing squarely on the practical application and maybe most importantly, the why it matters. I promise you, by the end of this deep dive, some serious light bulbs are definitely going to come on.
Okay, so let's unpack this. Seller financing. It gets called the ultimate tool in real estate all the time. But maybe for someone who's more used to traditional bank loans, what's the real, game changer here? What can it do that traditional financing just can't touch?
Yeah, it really boils down to one very powerful concept, the ability to create your own terms. See, unlike the, let's say, rigid structures of traditional lenders, seller financing lets you actually craft solutions that genuinely solve problems for both you, the buyer, and the seller. That flexibility, it's just a profound competitive advantage.
Okay, and this next point feels absolutely crucial, maybe often overlooked. Before you even think about making an offer, the groundwork, it seems, really starts with meticulous due diligence on any existing debt. So how do you actually uncover those existing loans? The balances, interest rates, the due dates. Our research really emphasizes you often need to physically examine the deed. And the process, it varies county by county. In Hine County, Mississippi, you might be heading down to the Chancery Clerk's office. But then in places like Rankin or Madison counties, you can often pull those public docs right online, which honestly is a huge time saver, a game changer for efficiency.
Absolutely. And knowing about any existing debt before you make that offer, it just makes the offer so much more meaningful.
Right. If you skip that vital step, your offer's effectiveness is severely limited. You're basically operating in the dark. You just can't propose a truly viable solution if you don't understand the current financial picture of the property.
Right. Okay, let's shift gears a bit. Let's talk about something really foundational for protecting yourself. Non-recourse loans. What does non-recourse actually mean in plain English? And why is it so critical for minimizing, your personal financial exposure, that sort of pucker factor?
Okay, non-recourse. Basically, it means the property itself is the only security for the debt. That's it. Your personal assets, they are explicitly not at risk. And one really powerful way to achieve this, as we saw, is by taking title in a trust. Because by definition, neither the trustee nor the beneficiary are personally liable. It's built into the structure of the trust. Okay, and to really illustrate how critical non-recourse is, imagine this scenario. It's pretty vivid. You borrow, say, $100,000 on a house, initially worth maybe $140,000, then disaster strikes. Frozen pipes, bang, $100,000 in damage. And then your insurance denies the claim. Why? House was vacant for over 60 days. Happens all the time. So now the house is only worth maybe $50,000. If that was a recourse loan, well, the bank forecloses, sells it for the $50K, and then they're coming after your personal assets or everything in your LLC for that $50,000 shortfall. Massive exposure, That's exactly what non-recourse eliminates.
Exactly. And what's fascinating, really, is how non-recourse fundamentally limits your personal liability. It protects your entire estate from that kind of devastating outcome. Now, you might think, oh, that sounds hard to negotiate, but actually, it's often quite straightforward, especially for things like IRA loans, where it's usually an IRS requirement anyway. In fact, nowadays, you can even use advanced AI tools, like platforms similar to ChatGPT, to help draft the specific non-recourse language for your legal documents.
Okay, so if you're going to really dive into seller financing, you absolutely need to master how to make offers and, importantly, how to navigate the common roadblocks. So, with that foundation laid, what are the most effective strategies for actually presenting offers?
Yeah, a key strategy is presenting multiple options. Don't just give one price. For instance, you could offer, say, $50 K cash, or maybe $60 with some cash now, rest later. Or even bump it to $70, but with a low down payment and seller financing the rest. This creates what you might call a confusion factor for the seller. A good kind of confusion. They stop thinking if they want to sell and start thinking which of your appealing options works best for them.
Interesting. Now, one significant roadblock we kept finding, maybe surprisingly, is often the real estate agent involved. Why? Why might agents not accurately present these seller financing offers? What's going on there?
Well, it often comes down to, frankly, a lack of education on this specific topic, and yeah, maybe it's a potential hit to their commission. Lots of agents just haven't been taught these more nuanced financing methods in real estate school. It's not standard curriculum. So they might just call the seller and say, you don't want this offer, maybe dismiss it before the seller even sees the full potential, the full proposal.
Okay, so that's a real challenge. How do you directly tackle that agent roadblock then?
Yeah, we found a couple of pretty powerful strategies. One is you can actually include a clause right in your contract. It states the offer must be presented in the physical presence of both you, the buyer, and the seller. Or, maybe even more direct, you can mail the offer straight to the homeowner. Bypass the agent initially. Now, the homeowner, they have a contract with their listing broker, so they are responsible for telling their agent. But what's interesting is homeowners often hang on to those physical offers, even if they aren't ready right then. It becomes a very effective card that stays on their desk.
Makes sense. Okay, let's shift to negotiation tactics. One huge plus we saw is the ability to make as-is purchases, after your inspection. And seller financing, it can seriously slash closing costs. I mean, think about it. Traditional realtor fees, closing costs, that can easily be, 9%, 12% even? Seller financing helps you dodge a lot of that.
Absolutely. And the flexibility, it goes way beyond just the price. You could, for example, agree to close in a year. Maybe the seller's building a new house, doesn't want to move twice. Perfectly reasonable. But for these slow closes, especially if there's no earnest money down, there is a risk. We call it seller amnesia. They might forget the deal or get cold feet. So to counter that, it's really crucial. Record the contract. Record it with an affidavit that includes the legal description and clearly states your intent to close on time. Protects your position.
Okay, let's talk earnest money.
Hey.
That often comes up. If a seller asks for it, how do you handle that conversation?
Yeah, there's a powerful tactic here. You can offer to put up 100% of the sales price in escrow if the seller does the same. Match me. Their typical reaction, it's usually something like, let's not worry about that then. Let's just close. It's a way to show you're serious, demonstrate intent, but it often makes the earnest money request just disappear.
Clever. Okay, what other smart negotiation tips did our material surface? Any little tricks of the trade?
Oh, yeah. Always offer to deal with any unwanted stuff left in the house. This can be a huge motivator, especially if you're dealing with, say, hoarders or just folks who are overwhelmed. Also, try negotiating in the worst part of the house. Stand under that leaky roof while you talk price. It subtly reinforces the property's actual condition. And don't underestimate building rapport. Notice personal things like photos on the wall. Connect with the seller as a person, not just a transaction.
Right, that human element is key. And, a truly successful deep dive here, it isn't just about your benefits as the buyer. It's got to be about understanding the seller side, too.
Yeah.
Their motivations, their problems. How can you effectively position yourself as the ultimate problem solver for them?
Yeah, you really can become an authority on solutions for the seller, even if you don't personally have all the answers right there. It means knowing about things like, okay, what's the probate process if it's an estate? Or what are common title issues that hang up sales? How do foreclosures actually work? You should also be familiar with key tax benefits for them, like the Section 121 exemption. That lets sellers exclude a big chunk of capital gains on their primary residence sale. Just understanding these complex areas, it positions you as this incredibly valuable resource, not just another buyer.
And speaking of taxes, a really key benefit for sellers, especially with investment properties, is the installment sales method. Can you break that down? It sounds important.
Oh, absolutely. Huge. This method, it lets sellers get taxed only on the money they receive in a given year, not the total gain all at once. So like if they have a $100,000 gain on an investment property sale, they're only taxed on the portion of that gain they actually get paid in, say, year 1, year 2, and so on. This can literally save them a ton of money in taxes. It spreads the liability out over potentially many years. Big selling point.
Makes sense.
Okay,
So what are some common seller pitfalls you should watch out for? And maybe how can you leverage those situations?
yeah, common pitfalls. Definitely focusing only on the top line price, ignoring the terms, getting, well-meaning but ultimately bad advice from friends, family, maybe even their hairdresser, and also just failing to plan for what they'll actually do with the cash proceeds from a sale. A great question to ask is, so if I just paid you all cash today, what would you do with that money? It kind of gauges their financial savvy, and sometimes it even opens the door for you to say, hey, what if I borrowed some of that back from you? Creates another layer, another potential win-win.
Interesting. Okay, and our research pointed to some specific types of sellers who are often the most motivated. Who should you be looking for?
Right. The highly motivated ones often fall into a few categories. The owner, who's literally in the moving process, they have hard deadlines, right? The recently widowed spouse, it's a difficult time, decisions need making, which is why, maybe surprisingly, tracking obituaries can be a valuable strategy. And of course, the classic ones, vacant houses or owners who live out of town. All these situations create significant motivation you can potentially solve. And to proactively reach these folks, mailing offers directly to the homeowners. It's just a powerful, persistent strategy. That physical offer, like we said, acts as that card they'll keep, they'll consider maybe for months. It's way more effective than just sending some generic marketing postcard.
Okay, now we're getting into the really juicy stuff, the core of some of the most advanced and honestly truly lucrative strategies.
Right.
Wraparound mortgages, or wraps. Our material literally says these are the best tool you have for buying and the best tool you have for selling. Wow, can you even wrap a wrap?
Ha! Yes, you absolutely can wrap a wrap. It gets layered. But let's break down the basics first. Buying with a wrap. Okay, imagine there's an original loan on a property, say $50,000, 5%, 30 years. It's halfway through its term, so maybe there's $34,000 left on it. You come in and offer, let's say, $40,000 for the property. You put $6,000 down, and you take the property subject to that remaining $34,000 debt. Now, critically, this is not an assumption of the loan. That's key. Assuming it would mean you have to qualify, and you'd likely lose the non-recourse nature of the original loan, potentially. The benefits here are huge. Maybe you only need another $5,000 for repairs. So you're in for $11,000 total. The property might rent for, say, $800 a month. And you could even potentially use an IRA for that $11,000 purchase and repair cost, get tax-free income down the road.
Okay, wow. So that's buying with a wrap. Subject to. But then how does this strategy transform into this powerful tool for selling? How do you generate that printed profit we hinted at? Walk us through selling on a wrap.
Right. So using the same example, you bought it for $40, subject to $34K, put in $11K total. Now you turn around and sell it. Let's say you sell it for $69,000 and you get $11,000 down from your buyer. What just happened? That $11,000 down payment you received, it pays you back your initial $11,000 investment. Purchase and repairs covered. You're now at a zero money in position. Instantly. You then finance the remaining $58,000 for your buyer, maybe at, say, 9.9% over 30 years. Now look at the wrap equity. You owe $34K on the underlying loan, but someone owes you $58K. That's a $24,000 spread. Instant printed profit on paper day one. Yeah. Plus the cash flow. You're collecting payments on $58K at 9.9%, while you're only paying out on $34K at 5%. That difference, that spread. It creates a really nice positive cash flow every single month, maybe a couple $100 or more. And any escrow for taxes and insurance, it just becomes a wash through. Money in, money out. A conduit.
Okay, that makes sense for the seller. I mean, but why would a buyer choose to take on a wrap like that instead of just getting their own loan or renting?
Good question. For the buyer, it often means a lower monthly payment than market rent. In our example, maybe their payment on the wrap is $654 a month, but renting a similar place might cost $800, maybe more. So it saves them money monthly. Plus, they've put down $11,000. That's a powerful incentive for them not to default, not to lose that down payment. It helps ensure you get consistent payments. Often, it's the best or maybe the only path to home ownership for them. If conventional financing isn't an option, it solves their problem too.
Got it. So the paperwork. What are the absolutely crucial documents needed for these wraps? Can't mess this up.
No, you really can't. 3 things are absolutely essential. 1, the WRAP promissory note that's the IOU from your buyer to you. 2, the WR deed of trust that secures the note against the property. And 3, the actual deed conveyance, the document transferring title. It must explicitly state that the transfer is subject to the existing underlying debt. That language is critical, non-negotiable.
Okay, and what's absolutely vital when you're disclosing all this to your wrap buyer?
Yeah.
How do you protect yourself there?
Full disclosure, period. It is paramount. You absolutely need to get your buyer to acknowledge, clearly in writing, that they understand it is a wraparound mortgage. They know there's an underlying loan. This prevents any future headaches, any legal issues where they might later claim, oh, I didn't know it was a wrap. Transparency protects everyone involved.
Okay, makes total sense. Now let's tackle the elephant in the room for many people when they hear about subject to or wraps. The due on sale clause.
Right.
What exactly is it? And, what does it really mean for you if you're doing these deals? How worried should you be?
Right, the due on sale clause, it's a standard provision. You'll find it in most mortgage documents, like paragraph 17 or 18 usually, in a Fannie Mae deed of trust. And basically it gives the lender the option, the right, not necessarily the obligation, to demand immediate full repayment of the entire loan balance if the property is sold or transferred without their prior written consent. It's there to protect the lender's security interest, essentially.
Okay, so it gives them the option.
Yeah.
But let's clarify the consequences. If they do exercise it, it's criminal, right?
Yeah.
You don't get fined.
No, absolutely not. It's not criminal. There are no fines. It's simply an acceleration clause. If the lender decides to call the loan due, they'll send a formal notice. Usually gives you about 30 days to pay the loan off in full. And, as our research consistently showed, the absolute worst case scenario for you, the person who bought subject to or created the wrap, you might potentially lose your initial investment, that down payment, which, while not ideal, significantly limits your overall exposure compared to, say, a recourse loan disaster. And importantly, there are strategies for managing this risk, proactive strategies. You can, for instance, include specific language in your initial offer to the original seller, acknowledging that you might sell the property on a wrap in the future. Gets it out in the open early. You can also try proactively seeking permission directly from the lender. There are standard permission to contact the lender forms you can find online. Sometimes they'll grant it. Now, technically, the original borrower usually remains responsible if the loan is called due. But think about it from the lender's perspective. Their security position isn't diminished. They still have the house as collateral. And now they effectively have 2 parties who have a strong interest in making sure that underlying payment gets made, the original borrower and you, the wrap creator.
That's a really interesting perspective. Okay, wrapping up our discussion on wraps. Well, let's touch on some really creative applications we found. Like, you can actually improve the original seller's liquidity, the person you bought from subject to, by creating multiple notes within your wrap structure. Can you explain that? For example, if you owe them, say, $30,000 via a seller finance note as part of the deal, instead of one $30K note, you could structure it as maybe a $15,000 note and another $15,000 note. Corrected example based on outline intent. How does that help them?
Yeah, that's a neat trick. If that original seller later finds themselves needing, say, $15,000 cash quickly, it's much easier for them to sell just one of those smaller $15,000 notes on the secondary market than it would be to sell the single, larger $30,000 note. It gives them flexibility they probably wouldn't have thought of. And even better, for you, you can build in a future profit center. Put a first right of refusal clause in the note you give the seller. This means if they ever get a legitimate offer from someone else to buy that note, likely at a discount, they have to offer it to you first at that same discounted price. So you potentially get to buy back the debt you owe them for less than face value. Another win. And really, what's truly powerful when you put all these pieces together is how these strategies essentially let you, print money. You're generating significant equity, creating cash flow streams, often with very little, sometimes no money out of your own pocket after the initial moves, and crucially, with no personal liability hanging over your head. It raises an important question, doesn't it?
It really does. We've taken such a deep dive into seller financing today, from, safeguarding your assets with non-recourse to the incredible leverage you get with wraparound mortgages. We talked about navigating agents, positioning yourself as that authority, that problem solver for sellers, and how to strategically print money. So maybe consider this as we wrap up. How might Truly understanding seller financing, seeing it not just as a transaction, but as a potential strategic partnership designed to solve complex problems. How might that fundamentally change the way you approach every single potential real estate deal you look at from now on?